Hello traders, James Stanley with StoneX and Forex.com. Is AI a bubble? That was the big question just a week ago when we had some sizable pullbacks on a relative basis in U.S. equities. Those headlines have taken a step back as we've seen now a 4-day rally in the Nasdaq, but I think it's still a viable question because this could still be argued as a sell the rip type of backdrop. I think more importantly for a trader, it doesn't matter. And I wanted to explore that in this video. In this video, I want to talk about the bubble paradox. I want to do this by examining both whether we're in a bubble right now, and if we are, how do you approach it? I'm going to look at the chart. I'm going to show you how to handle either scenario. So if you're a bear and you think we're on the verge of a massive bubble bursting, I'm going to show you how to do that. Or if you're a bull and you're looking to fade fear and buy panic, I'll show you how to do that too. The aim is to do so in a professional manner rather than just hoping and praying that the lottery number that I picked turned out right. But first, I want to start off with an item that began my study in bubbles more than 20 years ago. It was a quote from former Fed Chair Alan Greenspan. It's more than a quote, really, as it's a phrase that he coined while asking a question that I think perfectly encapsulates the very nature of the true paradox behind bubbles. This was a speech on December 5th, 1996 to the American Enterprise Institute, which is going to come up in a moment. And I need to read the full statement. The full statement was, I would argue that in this environment, we are seeing the effects of a new paradigm based on sustained low inflation, which has been made possible by the long-term decline in the risk premium on capital. This is the important part. My question is whether in this new world we will be able to identify asset bubbles until they've already burst. How do we know when irrational exuberance has unduly escalated asset values, which then become subject to unexpected and prolonged contractions? That's the important phrase, irrational exuberance. But more important than that is what Mr. Greenspan said just before that, which is we can't technically know with certainty that something is a bubble until after it's burst. And if you're a trader, that matters. Because after it's burst is already too late. As a matter of fact, after it's burst, it might be better to start looking for ways to get long. But this brings to bear a couple of other interesting points. And I want to draw your attention to an article that was authored in 1999. And we're going to look at how this proclamation played out. And I'm going to link this to another paradox. This is an article from the American Enterprise Institute, where Mr. Greenspan was speaking when he originally had the irrational exuberance comment. Interestingly, this paper was co-authored by Mr. Kevin A. Hassett. Kevin A. Hassett is this gentleman right here, the current director of the National Economic Council. I bring this up because it was just a couple hours ago that U.S. Secretary Scott Bessent, U.S. Treasury Secretary Scott Bessent, said that Kevin Hassett was the front runner for the next Fed chair position. Well, Mr. Hassett had some pretty pointed words from Mr. Greenspan back in September of 1999. Has Alan Greenspan joined the ranks of bubbleologists? He references a speech from August of that year, but it was the same irrational exuberance speech that he discusses right here. Mr. Greenspan issued his famous admonition about irrational exuberance of investors. It's true, he joins a group that is both distinguished and embarrassingly wrong-headed. Consider the bubbleologists at The Economist magazine, whose perpetual taste for imminent stock market disaster is reflected in such headlines as Echoes of the 1930s, Heading for a Fall, and America's Bubble Economy. Bubbleologists think stock prices are driven by a kind of insane euphoria that will end any minute. This is interesting because bubbles sell headlines. As a trader, it becomes noise. It becomes a distraction. The volatility can be welcome to many different types of strategies, but I think it's still incredibly difficult to actually profit off of one, even if you know that we're in one. Which brings up another important point. The rational bubble paradox. This was a concept coined by an American economist named Paul Samuelson in a paper in 1958. Paul Samuelson is notable because he's the first American economist to have earned the Nobel Memorial Prize in Economic Sciences. He earned this in 1970. The Swedish Royal Academies at the time said he has done more than any other contemporary economist to raise the level of scientific analysis and economic theory. Now, Mr. Samuelson's theory, the rational bubble paradox, it essentially counters the efficient market hypothesis. The efficient market hypothesis suggests that asset prices reflect all available information. So, per that theory, if there is a bubble building, then rational investors will sell it and prevent the bubble from actually building. Of course, EMH has been largely replaced by behavioral finance over the last 30 to 40 years. But in Samuelson's 1958 paper, he described the concept of rational bubble, which is speculation backed by no fundamental value, but by the belief that the asset could be resold for more money to another rational investor. Which is interesting, because anybody that's dabbled in cryptocurrency markets over the past 5 years has to be familiar with the greater fool's theory. The greater fool theory is where investors may buy an overvalued asset, believing they could sell it for a higher price to a greater fool before the bubble bursts. The challenge here, of course, lies with the timing. Selling too early means missing out on possible upside, while selling too late requires taking losses. So, greater fool theory has some links to Mr. Samuelson's rational bubble theory. Again, it's a challenge to efficient market hypothesis, and then the paradox is built on the assumption of rational expectations, where all agents are fully aware of the asset's fundamentals and the possibility of a bubble, yet they still participate in it. Point of bringing this up is because Mr. Greenspan had this comment, this very strong, insightful comment on December 5th, 1996. And when we look back at Greenspan's career, it's often considered to be a highlight, as he was one of the first to point out that there was a bubble building in tech stocks. Unfortunately, if Mr. Greenspan had laid into a short position at that point in time, unless he had absolutely no leverage, a really long holding period, and an iron stomach, he was probably going to be in a pretty bad position. December of 1996, the Nasdaq 100 opened the month at 844.63. That's when Mr. Greenspan made the irrational exuberance comment. The Nasdaq 100 then went up by a whopping 470%, 486%, until it finally topped in March of 2000. Kevin Hazlett's comment, which, with history, seems ill-timed. Well, not necessarily. Kevin Hazlett's comment, September of 1999. The Nasdaq 100 then went up another 100% by March of 2000, so not even a full year. This highlights how powerful market behavior, particularly when you have a strong trend, can be. Even if you know that we're in a bubble, you could end up losing a lot of money by sitting there and shorting every rip and every bounce. Or even if you just sit on the sidelines, you could miss massive opportunity, which is what brings up Paul Samuelson's rational bubble paradox. Because the reality is, fundamentals are a very subjective manner, and they shift and they change. Now, one of the chief drivers behind fundamental consideration are interest rates, which is kind of like Kevin Hazlett had alleged here, when he essentially said that if Greenspan wants to address the bubble, and you're welcome to Google and read through this article, if Greenspan wants to address the bubble, he's going to have to raise interest rates to pop the bubble himself. Well, that doesn't necessarily have to happen. But if we look at the way that the Nasdaq has performed in the 25 years since topping with the tech boom in March 2000, you'll notice that many of these episodes did come along with interest rate hikes. such as the pullback that we saw in 2022. Now, that's, I think, less of a bubble bursting and more of a pullback. But again, this video is about how to trade these disasters and these scenarios. And highlighting the fact that even spending a moment questioning whether in a bubble is kind of a waste, and it's somewhat of a distraction. The reality is, if you look at these situations, there are very clean and clear market structures that build on the way up and on the way down. Now, from the monthly chart, you could see where we'll run with this euphoria, and then it will stall. But then buyers come in to bid those dips. Again, rational behaviors, expecting they'll be able to sell these assets to other rational investors for a higher price down the line. But it's when we begin to break down and we get these swing lows that then become swing highs that selling opportunity exists on the way back down. Now, we can even go to a weekly chart and notice these market microstructures holding in an even more clear manner. Patience. Looking for opportunistic ways to sell with relatively light risk outlay. For instance, when we have this breakdown, you know that there's a trend that could be building. Chasing that break becomes really tough because it might snap back and run through your stop. But when you do get a breakdown, you could simply mark a line in the sand and say that's a point of resistance. If I see sellers starting to react to that, then I'm going to look at that for further short side setups or opportunities. And then you get the same thing on the way down. Or maybe even use some of these reference points, these prior points of support that mattered on the way up, which perhaps coincidentally is right around that 2,000 level. Nice round psychological level at 2,000. Try to not let the FOMO get the best of you. Try to not let the headlines telling you that this bubble is bursting and you have to act now. Try not to let that drive your behaviors. But you had this very clear support that built on the way up. Now it becomes resistance on the way down, and that becomes a way that you can try to approach trading a bubble bursting. Now, in the Nasdaq 100, Mr. Greenspan's timing was off. His call was correct. In trading, timing matters. And the fact of the matter is, and I'll tell you point blank, I think that currently we are in a bubble right now. But I don't think that it has to end yet. It can continue to rip and it can continue to rally. I think the big risk here, and I have to guess, the big risk here is that inflation surprises to the upside. It puts the Fed in a position where they have to hike rates at some point in 2026 or maybe 2027. And then that becomes a massive hindrance to further gains. Because right now, capital is being quickly allocated into equities. That means when we do finally have a reason for investors to sell, it could quicken, like we saw in February to April. But at this point, if there's not another attractive venue to be adding that capital towards, there's more reason to bid stocks higher in anticipation that another rational investor will buy it at a higher price later down the road. Now, I looked into treasuries last week. I'll just touch on that briefly. And that's what I think ultimately could become that opportunity cost, that venue to draw capital away from equities. But I don't think that we're there yet. Now, in more concrete matters, I'm going to go to Nasdaq 100 cash, and I'm going to show just a very simple backdrop here. If you're a bear, this is kind of what you want to see. From those lows in April, we had the build of a rising wedge pattern. A rising wedge pattern is a bearish reversal pattern. And that's what started to play out over the past month. It's a bearish reversal pattern because the same enthusiasm that have drawn bulls in at these higher lows isn't really shared at higher highs. Ideally, when you have a healthy bullish trend, buyers are willing to stretch. They're willing to push breakouts. They're not as afraid or cautious of getting long on fresh highs. But once that caution begins to show, as illustrated by a weaker angle on the resistance trend line, that's when we might be hitting a fever pitch. That's when we might be getting to a point where the market is heavily one-sided and due for a pullback. And that's what started to play out here from October 29th, which is an important date. October 29th was the most recent FOMC rate decision. This is when the Fed said they weren't a December rate cut was not a foregone conclusion. So it triggers lower lows and lower highs. So deductively, I think that highlights if we do get a December rate cut, there could be bullish fuel into this thing as we go into the end of the year. That said, given the pathway down, there is still some bearish structure that sellers can work with, and in anticipation that the rising wedge may continue to fill in. Now, this zone, I think, is the key one. This was some open exposed gap from earlier in November, and it runs from 25,762 to 25,972. This is a closer area. This is one that could come into play like in the next couple of trading days. But it's 25,386 up to 25,517. Again, open exposed gap that hasn't yet been filled in. And automatically, if we get up there and we see an element of stall as indicated by an upper wick on a daily candle, or maybe even a 4-hour candle, then that could be an open door to take a shot at shorts. If you're a bull, well, the rally that we've had over the past 4 days is incredibly difficult to chase just because of how far away it has moved. The down move in Nasdaq was like 8.9%. Again, this was cash. The up move from those lows last Friday, peak 6.1%, total 5.8%. That's a lot of risk to take on when we're about 5% from the highs right now. So even if we do go up and match that prior ATH, that's still slightly under a 1-1 risk-reward ratio. Not super attractive. What is, I think, a bit more attractive is if we look at some of these other open exposed gaps, like we have this one from earlier this week, hasn't yet been filled, runs from 24,239 to 24,455. That becomes a pretty meaningful area. If we see prices dip down, but buyers show up to support, especially if we have an underside wick like we had last Friday, showing that they are responding to those lower prices, that becomes attractive. A little bit deeper, or a little bit more shallow, rather, there's some open exposed gap right in here. This was from earlier today, and again, I'm shooting this on Wednesday ahead of the Thanksgiving holiday, but that runs from the close on Tuesday to the low on Wednesday, and it's right around a pretty massive spot. That pretty massive spot is the 25K psychological level. So that's like the S1 zone, the S2 zone is right down here. So a couple of different ways to proceed on this index, again, specifically Nasdaq Cash Index, depending on stance and depending on the way that you want to take the move. Now, we can also look at this from the perspective of Nasdaq Futures. I have this one a little bit more clean because I just have a few annotations on this, but this was the same chart I've been looking at in webinars, and there was a confluent spot of support that came into play last Friday. And what I've essentially done is I've just taken a Fibonacci retracement from the 2022 low up to the high October 29th, right around that Fed rate decision. And the 14.4% retracement of that aligns with the 23.6% retracement of the shorter term move, taking the April low up to that same high. Now, what is attractive is the dance that this did on the 4-hour chart, because you could see where there was an open door for sellers to go for the jugular here. They just continually failed to do so. This is exactly what you want to see as support. Now, you don't know that it's going to hold. Maybe sellers take another shot and they take it down. But the entire premise of this is you know where the line in the sand is and where you're wrong. And as a professional, I think about the best thing that you could do as a trader, from a strategy perspective, is to buy support and sell resistance. And the whole reason for that is because you can implement if-then statements and you know where you're wrong. Because the future is going to be unpredictable. And even if you know the price is going to go up, you don't necessarily know that you won't get stopped out along the way. So you have to figure out ways to try to incorporate that timing element. And something like this, when you see a very clear Fibonacci level coming into play, illustrating that dance on the 4-hour with those underside wicks, showing buyers responding to that price, that automatically becomes an attractive way to look for continuation. Well, we're a little bit far from that point now to use that for any type of risk management level. Again, we're further away from that low than we are from the high, or probably just about. Yeah, we're like 5.9% off that low, and we're only like 4.29% from that high. So that would be entirely too much risk unless you think that we're going to get a strong breakout beyond that point. So you need to look for some price improvement if looking to be bullish. That 25K level is what I think sticks out. There is also a little bit of unfilled gap down in here, so we could mark that as another possible support zone. Taking that close from Friday up to the low on Monday. And again, it's slight, but there is just about 11.75 points of gap in there. And that could be like an S2 level. If bearish, I think this is the big level that plays. Prior support turned resistance. That's 25,853. And we can go a little bit shorter term to find some other possible resistance, although it gets a little bit messy. Notice we had this resistance up here at like 25,500, just around 25,500. And I think this could be looked to as well. But you want to see the level play. You want to see sellers react if looking to get short, or buyers react if looking to get long. And then at the very least, you know where the play is wrong. You know where the support isn't going to hold. You know where the setup is wrong. Okay, and lastly, I want to look at cash SPX as well, as this has been a pretty big part of forecast for the past couple of years. And, again, it was a relatively mild pullback, and I think that's why this whole event is notable. And SPX, cash SPX, was a 5.76% pullback from peak to trough, and this is where we still had that extreme fear reading showing up. That's notable. It shows you that markets are kind of skittish, kind of scared. If we got some further disheveling, there could be more selling. But if you're a bear, again, I think this is about what you want to see. We've pulled back aggressively off the lows, and we're holding at one of those prior gap areas. It has since filled, but one of those prior gap areas, and there's even a little bit more of new unfilled gap in here. But I've been tracking this level like 68.29 up to 68.51, and then this zone, a secondary resistance zone, 68.32 to 68.90. You'll notice we're a little bit closer to the highs here in SPX than we are in Nasdaq. So if you're a bear, I think the Nasdaq 100 still is a little bit more attractive. If you're a bull in SPX, it's this zone that I would really like to see hold on pullbacks. It's a wide zone, again, prior gap that has seen a lot of action since then, but it runs from like 67.38 up to 67.72. But again, whether we're in an AI bubble or not is, I think, less meaningful if you're an actual trader looking to profit off of it, because that's just cannon fodder. And it's cool for headlines. It's cool for magazines or newspapers or websites to get traffic. But the reality is, like Alan Greenspan, you can know that we're in a bubble. If your timing is wrong, it doesn't really matter. You're going to get made fun of in the media by your contemporaries, because timing these things is incredibly difficult. And I think as a professional, especially as somebody that's main focus is trading and trying to profit off of markets, I think about the best that we could do is analyze structure, buy support, sell resistance. I get it. It's not as exciting as saying, I sold the very tip top of the bubble. But the reality is the probability of being able to do that perfectly, especially with any degree of consistency and replication, is incredibly low. So trade what the chart gives you, work with the backdrop that we have, and try not to fall victim to your own devices of the fear of missing out and the panic and euphoria that the financial headlines would want you to get to fall prey to. But that, my friends, is what I have for this video. As always, thank you for your time, and happy trading, ladies and gentlemen.